Hello, welcome everyone to Calling All Real Estate Investors. This is a live event hosted by Caeli Ridge at Ridge Lending Group. You can reach us at info@ridgelendinggroup.com by email, or you can give us a call. That's 855-74-RIDGE or 855-747-4343. So we have switched to a new schedule of these live calls. So instead of taking place every Tuesday, we're going to be taking place the first and the third Tuesdays of the month. And that's going to be at 1:30 p.m. Pacific time, 4:30 p.m. Eastern time. But this month we do have a special episode for you guys, a bonus episode on August 29th. It's going to be with a guest speaker. Her name is Tanisha Souza. She is with TARDIS Wealth Strategies. So she's going to be talking about her income snowball. So this is something that she helped develop. It's showing you how real estate investors can buy rentals faster by providing you with larger amounts of cash flow. And then our next following that is going to be on September 5th, that Tuesday, and we're going to have another guest speaker. So back-to-back guest speakers. The one on the 5th, her name is Karen Hall. So she's a self-directed IRA specialist. So she's going to show you how to take self-directed IRAs and how to purchase real estate within that self-directed asset class. So those are really exciting. Looking forward to that. And for today's call for participation, please just utilize the chat feature whenever you have a question, pop that in there. We also have it so that you can unmute yourself if Caeli does call out to you for any additional information on those questions, but she will get to those as soon as she is able to. All righty. Handing it on over to you, Caeli. Thanks, everybody.
All right. Thanks, K-Bad. She's really coming into her own, isn't she? She's sounding good, Carly.
Thank you.
You're raising the bar, sister. Thank you, my dear. It's good to see everybody. Thank you for joining us. I have just a real quick, Doc Wex, I owe you a call. I see you're here. You are on my schedule today. I will reach out. Hopefully we can connect if you're available. Thank you for your patience. All right, so today we're talking about amortization versus interest only. I've got some visual aids I'm going to share with you guys in just a second. But before I get to that, just a few housekeeping things for me that I wanted to ask you. Carly, I don't know if you can do this on the fly, get ready with a poll for us. I had a conversation earlier with a client today, and she had mentioned something about a master class for the all-in-one. You guys know that I'm such a huge fan of the all-in-one for reasons that I've ad nauseum shared with you. But I feel like because it's such a different concept for us here in this country, particularly, that people hear it, they still don't really grasp it. And for those of you that continue to have questions or just don't get it, once a month, maybe the first Monday of the month, I don't know, we'd figure it out. But a masterclass where we really dig into conceptually and logistically all of the different variants, nuance, interest rates, adjustable rate mortgage, all of the different things that make up this all-in-one. For those of you that are interested in something like this, it would be the same. I'd come up with a syllabus, for example. It would be the same thing every month that I would put on this masterclass for people that would want to attend. So a yes or a no, Carly, is that something you could do really quick? For those of you that are here today, anyone that's listening after the fact, if you guys just want to email info@ridgelendinggroup.com and say, yes, masterclass on the all-in-one would be of use, please let us know. I'm happy to do it if there's a need for it. I just need to know that you guys are interested in that. So there's our poll. I think everybody can see it. If we want to get some yeses or nos, anyone that's interested in this free service of all-in-one. Okay, it looks like it's a unanimous so far. Okay, so that's a yes. I'm just going to say, let's give it another second. 5, 4, 3. Okay, good. I think then maybe we'll go ahead and do that for you guys. We'll put out those details as soon as we have them. And so just be on the lookout for that. And then also just heads up, this Friday, you're going to get our newsletter. We're talking about property management. And I thought that sometime in September, I would go into some of my own personal experiences about, property management, good, bad, and in between. For those of you, we'll go ahead and promote it in advance that want to come with their own stories. Maybe we could share and do a roundtable with like-minded individuals like ourselves, and we can talk about some of the pitfalls that we've had as property managers. So I thought I would do that, provide you guys with my own personal experiences over the years with property management. Some of it may be obvious and redundant, while other bits and pieces may be useful that you hadn't heard before. We'll see. Okay, so let's go and get into today's topic. Amortization versus interest only. So I want to start by saying, guys, that I have always been a pretty big fan of, hold on here, a pretty big fan of an ARM and an interest only product for a variety of reasons. I'll get into those in a moment. Let me get my stuff together here because I want to share my screen. Okay, I'll get ready for that. Just let's talk about the basics. Okay, amortization is actually a fairly simple simple way of understanding. It refers to the amount of principal and interest that's paid each month over the course of your loan term. Okay, near the beginning of the loan, the vast majority of that payment that you guys are making is for what? Interest, right? Goes toward interest. So amortization is just a function of the split between interest and principal that your monthly payment is comprised of over the term of your loan, 15 years, 7 years, 10 years, 30 years, right? That's what amortization is. It's that interest rate, the term of the loan, and then the split between interest and principal that's paid every month. And it changes. The first part of the loan, let's use our 30-year because that's really what we're probably going to focus on. The first part of the 30-year, let's say the first 10 years, 98% of your payment is going to be towards principal. Very little, excuse me, towards interest. Very little of that payment is going to go towards principal in the first 10-ish years of that loan. That's amortization, okay? Interest only is exactly what it sounds like, right? It's a loan where payments cover interest exclusively. There is no principal being repaid on that loan. The accrual is interest only. Unlike amortized payments that pay both the principal and the interest, interest only will not pay down that loan balance. Pretty simple, right, guys? I mean, nothing too crazy about that. Interest only, principal and interest. Anybody have any questions about just the basic differences in interest only versus amortization? I'm going to guess no, so I'm just going to move on. If you guys have your questions, put them in the chat, raise your hand, interrupt me if you need to, whatever it is. So going back to my statement a second ago, I've been a big fan largely in my career of ARMs, adjustable rate mortgages, and interest only. I'll settle on the interest only part in a second. Let's talk about the adjustable rate mortgages. Big fan of adjustable rate mortgages in an appropriate market. We are not in that market right now. Very, very important to preface by saying that we are still in what's called an inverted yield. You've probably heard me mention that term before. An inverted yield means that interest rates for an adjustable rate mortgage actually price higher or not materially less or lower than a fixed rate mortgage that justify the means. Let me say that another way. Since 08-09, an interest rate, when I look at an interest rate between a 30-year fixed mortgage, all variables, all characteristics are equal, 30-year fixed mortgage and say a 5-year ARM, in most cases, not all cases, but in most cases, the adjustable rate mortgage is higher. Okay, well, where's the incentive? Why would you ever lock in an interest rate on a 5-year ARM if that rate is higher than, say, the 30-year fixed? You wouldn't. That's an inverted yield. On occasion, we'll see adjustable rate mortgages priced slightly better than a 30-year fixed. Maybe it's an eighth, maybe it's a quarter. Depending on the loan size, though, even then, I don't feel like it's justified. I usually want to see at least a half and more often a point, up to a point better or more on an adjustable rate mortgage to justify the means of going down that road. And under normal market conditions, all day long, I'm going to take an adjustable. Why? I like the adjustable because we know as investors that the shelf life, let me back up and preface, there's exceptions to every rule, okay? I'm talking generally, but the vast majority of us are not going to get a 30-year fixed mortgage and then pay 360 payments to where we pay off that mortgage. It's highly unlikely. I mean, the percentages are fractions, especially for investors. So knowing that as investors, we're typically, that shelf life is going to be around 5 years time to when we originate that mortgage to when we're selling it, maybe doing a 1031 exchange. Maybe we're doing a cash out refinance and harvesting the equity, of which is borrowed funds are non-taxable, right? Maybe we had a higher interest rate and we want to reduce the interest rate. Maybe we had a balloon on the mortgage and we need to refinance and get out of the balloon. Maybe we were in an adjustable and we want to be on a fixed. All of those different reasons can be why that 5-year lifespan or life cycle is typical for investors. Okay, so if we know that, that's going to be the case and we're going to be refinancing, and under normal market conditions, an adjustable rate mortgage rate is going to be, we expect, significantly less, a half a point to a point or whatever it is, maybe in between. Why wouldn't you take that lower interest rate? You would, right? So normally I am a big fan of those adjustable rate mortgages. Right now, not so much. I expect we'll see some improvement to that end where adjustables arms would be more to our advantage or favor. Here's my crystal ball. The next year or two, couple of years, it's been a long time coming. I actually was of the opinion that we would have seen some improvement to arms well in advance before now. The pandemic didn't help for a variety of reasons. But even before then, I expected that 08, 09, when we saw the housing and the lending implode on each other simultaneously, for those of you that remember that era, I expected arms to make a comeback before, even before 2020, and it hasn't. So I was mistaken about that. I get some things right. So I do expect that as rates start to come back down, as everybody is anticipating, that arms may play a bigger role in the coming months and years. Pay attention. You should be looking for that, or at least comparing it. You can decide that for whatever your reasons that an arm isn't a right fit for this property or for your circumstances. But at the very least, you should be asking the question and looking at the difference between the two and remembering that shelf life. Okay, looking back, for those of you that have some history with mortgages, go back and look 3 years or 5 years or 10 years and how often you in your own circumstances have kept a mortgage longer than X, Y, or Z. Okay, those are going to be important details for you in making future decisions on what kind of loan product to secure, if it's to your advantage, right? If you have that choice and we're not on an inverted yield. So big fan of the ARM, an even bigger fan of an ARM when appropriate, and an interest only ARM. And here's where we're going to kind of get into my feelings about interest only versus principal and interest. I'm going to share my screen now, and I have some notes here I took in advance so that I didn't have to try and strain my old eyes. I think I want to be on this one. Okay, hold on, gang. Okay, we're going to make, this is just a standard loan amortization table. Okay, you can get these anywhere. They're just go online, you can find, I like this one. It's just the one I've always used. Maybe that's why I like it. But these are very readily available anywhere you look online. We will make this available, Carly, in the community, please, so that everybody can have access to it. These fields up here are the input fields for you, and then the data is over here. All right, so I want to just kind of illustrate a few things. I've started at a loan amount of $350,000. Okay, an interest rate, I'm being very nice to our 30-year fixed principal and interest mortgage right now at 7%. It's actually higher than that. We've got 12 payments per year, and we're starting this mortgage in September. Okay, right now. Principal and interest payment is $23.2856. We're not making any extra principal reduction payments. If we did do that, for example, maybe that's part of this scenario or part of the strategy for any particular property. I'd want to talk you through that and have some Q&A about it. Normally, I'm not going to say on a closed-ended 30-year fixed mortgage, you should be making extra principal reduction payments because to get that capital back out is not easy. It's not liquid. In fact, it's cumbersome, the qualifying, the cost, etc. But if you did, you could mess around in here and see what were to happen with how much interest is paid and the payoff time, etc. This might be a fun feature if, for example, somebody comes to me and says, Caeli, I really only want a 15-year mortgage. I'm going to fiercely defend against that and say, no, you don't, because all that's going to do ultimately is detract from or discourage optimal debt to income ratio, because that 15-year amortization is half. I'll just give you an example. Let's go. So let's say that the 15-year mortgage has a rate of 6.5. Okay. So watch what happens. I'm going to draw your attention to this scheduled payment right here, this 2328. Watch what happens. So we go 6.5%. I'm getting off topic here, but bear with me. And 15 years. See what happened? The payment's gone up by what, $700? So while maybe you can afford that, not a problem, what happens to your debt to income ratio? Because this is what's going to report on your credit report. That's a $700 a month higher payment between the two, that over time, your debt to income ratio is going to suffer. When if you really intend on not paying the extra interest, and this payment is easy enough for you to afford, by all means do that, but do it this way. Watch. Let's see here. Somebody remember this number for me. 198, we'll call it almost 199,000 in total interest using 6.5 over 15 years. Okay, now I'm going to go back to 7% over 30 years. Okay, so I understand the premise, right? Nobody wants to pay twice as much interest, but what if we were to simply take our 30-year fixed, okay, comparing it to the 15-year, and apply $700 a month with our regularly scheduled payment? That's roughly the same. Okay, watch what happens. Much, much closer. We're paying off in 193 months versus 180 months in this scenario. But what we've done, so we've manually manipulated the difference in interest accrual, right? Because we're simply applying this every single month. I'm not saying that you should do this. I'm just illustrating a point. But we are not held to, our feet are not held to the fire at that higher monthly payment, and our debt to income ratio will stay intact. So if anybody is dead set on a shorter term amortization, I would tell them, take the 30-year, let's figure out the payment difference, and simply apply it every month with this payment, right? You're in total control. And even in the months, let's say, where maybe it went vacant for a month or two, you're, like I said, your feet aren't held to the fire, your DTI would be optimized, et cetera. Okay, I'll get off that bandwagon. Let's refocus now, Caeli. Okay. So our 30-year fixed, and comparing to our 15, I started our conversation by saying that the vast majority of your monthly payment, this guy right here, in the first 10-ish years of this loan, is going to interest, right? Well, I want to go back to that 5-year, 60-month shelf life, because we know that that's the approximate average that most investors keep their loans. Some would argue, or may have a comment on this call that say, well, the mortgages that they secured in 2020, 2021, and in some cases 2022, those interest rates are so low that they're never going to refinance those mortgages. I think that the percentage of people that let's go back to just real time. The percentage of people, especially investors, we're talking about investors right now, under normal circumstances, that start and stop with a 30-year fixed mortgage where they've made 360 payments later, and to pay off the loan is, like I said, a fraction of a percent. I think that because of the interest rates secured over the last couple of years, that fraction of a percent has gone up by maybe 4 or 5%. It's still a very, very small percentage. And while I understand people are really hard wired to want to keep those interest rates, chances are that loan will be sold or refinanced or paid off in some way or other because you've sold it for a 1031 exchange, et cetera. It's highly unlikely that you will finish making 30 years worth of payments on that 4% or 3.5% or whatever it is. Okay. Regardless, getting us back on track again, let's go down. So if you guys can see, Carly, can you see this pretty well? Is it small? Do I need to try and make it bigger?
It's a little bigger.
Maybe a little bigger. Okay.
Yeah,
let's see.
I think a little bigger.
Okay. Let's see if I'm smarter than I look. Hold on, you guys. Is it here? I don't think that's going to do it. If anybody is an Excel wizard and you want to tell me where I can go to make the fonts bigger, I know it's probably right in front. Here we go. Just kidding. Is that better?
Yeah, that looks better.
Okay. So left to right, we've got our first payment date. There's our balance. There's our payment, right? You can see how much is going to principal, interest, yada, yada, yada. Okay, I want to take us down. Don't look at the Excel numbers. I'd look at the inside the worksheet. So let's go to 60 months. Okay, right here. This is the guy that I want to focus on. This has been 5 years you've had this mortgage. And this is the beginning balance at the 5th year, 60 months. The ending balance is 329,460. That is the ending balance after 5 years of making mortgage payments. The difference between this and our starting 350,000 is 20,540. Okay, so over 5 years, you've paid down $20,000, 540. Now consider this. Let's take 7% interest only on $350,000. Your interest only payment would be, these are my notes that I wrote down. Interest only payment is $2,041.67. I take that minus 2328, right? Principal and interest, and that is a monthly difference of about $287 a month. Okay. Now what I want you to do is imagine taking that amount, $287 a month payment difference times 60 months is what? 17,213. Okay, 17,213 that you have been able to retain in cash flow that you've set aside versus the 20,000 that we've paid down the mortgage balance over that 5-year period of time. The difference between those two numbers is roughly $3,300. Okay, so $3,300 is the difference in the principal reduction and the interest only payment that you have retained in cash flow every month over 5 years. My next comment will be, what if you wanted to get access to that money? What if in 5 years' time, it's appreciated, whatever, okay, but you want to recapture some of that equity that you've built in this property? What's it going to cost you to do that? Is it going to be more than $3,000? Hell yes, it is. Of course it is. So just by itself, there's your difference. I would also argue that when you're looking at your Schedule E, your interest deduction that you can claim will be higher by X amount than if it were just the principal and interest, or than it would be the principal and interest that you were paying. The interest deduction is going to be less by about that much. So that would be a secondary piece. Does everybody see where I'm going with this and why I'm even talking about it? Does anybody have any thoughts or questions? Carly, anything that we want to get into?
We had a question earlier. Tanya asked, when you were talking about making those extra optional payments, does it help accelerate your equity?
Sure, but it's trapped equity, right? So yes, certainly you're going to be paying less in interest if you accelerate. That's true, but less in interest over the 30 years. Because remember that first 5, especially 5, and even into 10, the amount of principal that's being paid is a very, very small percentage of the overall payment. And again, just to reiterate, it's locked up equity. You can't, it's not like it's liquid. You can't get at it at a whim, or if you need it, you have to do what? A full cash out refinance, right? Or if it's available, some kind of a HELOC on an investment property in second lien position. Those are not going to be easy to come by right now, for sure. Will that open up in the future? I hope so. I would love I mean, that would be the best of all worlds, right? Everybody gets to keep their low interest rate on their first mortgage, right? If they're going to keep this property, they don't have plans to sell it or do a 1031 exchange. And that argument about how low the rates were and what they got, and that they don't want to get rid of it. If we can find HELOCs in second lien position, that's fantastic. As far as I know, and somebody feel free to disagree or give us some intel, those are not available. Second lien investment property HELOCs currently are not available. We have HE loans. You guys know that Ridge has closed-ended HE loans. That's not liquid. Those are going to be 12, 13% mortgages that are a 30-year, just like your first mortgage, 30-year amortized, closed-ended. Anyway, so did I answer that question? Who was the question from, Carly? Sorry.
Yeah, no worries. That was from Tanya. She said she didn't know that, and thank you for explaining.
You bet.
So let's see, Chris was just saying that his mind is blown, but he was able to get one of those loans that you were talking about in 2022. but it was considered a business LOC, but it was secured by a property. So.
Cool.
Mhm.
If you want to share with whom or who secured that for you, it won't hurt to check, you guys. If you can find a HELOC on investment properties, investigate it. Go and grab it. Go get one. I would advocate for the all-in-one. Anybody that wants to know why, just ask me and I'll explain. But I think it's superior in most ways, and then oftentimes even up against a 3% interest rate. Believe it or not, it's a velocity of money and banking. Well, we can talk about that another time. I don't want to get on my all-in-one soapbox. So okay, let's kind of bring this back around. Interest only, amortized. When it's viable, I am always going to go for the interest only for the reasons that I've described here. Are there exceptions to the rule? Of course there will be. So make sure that it fits with the project and the strategy and right, all of those things. But more often than not, for investment purposes, I love the interest only, right? You get to keep your cash flow. It's not tied up over here. You're not risking or really losing anything. In fact, I think that you're on the upside to do an interest only. And remember, I haven't even gotten into appreciation of rents, right? That's not even included here. This number won't change no matter how much extra you throw at it. That's still going to stay static and consistent. If you're appreciating your rents every year, which I believe you should be at a very modest 2 or 3%, very, very modest, then the conversation and the numbers that I just kind of spit out at you will even work further to your advantage. Thoughts, questions, gang? Anything about this or otherwise? I'm running out of content here. I think I went over, unless you guys want me to go back through the numbers that I know I went over it kind of quick. If anybody wants me to just reiterate.
Yeah, we do have a question from Chris. I think he was maybe talking about the difference in the all-in-one. Let me know if that's not right, Chris. But he asked, is there a difference in qualifying, or does it come down to DTI and or the property performance?
Yeah, I meant towards interest only, Carly.
Oh, thank you.
Yeah, is there a difference in qualifying for interest only versus a conventional? And kind of, so what do you look at to qualify for interest only? Or does it come down to the same metrics where, you know, DTI or property performance, you know, debt coverage? How does that kind of work out? Because I'm, again, mind blown. I made the discovery that for our personal houses, the interest rates don't matter at all for us. We never live anywhere long enough for the interest rate to matter. So I had been putting down 20% on the first several properties we owned, and then we kept moving within like 4 years. And I'm like, why am I doing this? It doesn't really matter what the interest rate is. It's never going to amount to anything big, you know, any big difference.
Yeah.
And so this is really blowing my mind, because you're absolutely right on the dollar amount you'll save, you know, or you know, spend less basically over 5 years, plus the tax implications, which would be for me huge, because I'm part of the overtaxed kind of, you know, upper edge of the middle class, not like upper class, but like I pay a huge amount of my income in taxes as an employee. Yeah. And so like that'll make up the $3,000 probably easily for me. And so like really, this is really, really interesting to me, because I never had done the math before.
I'm glad. That makes me very happy, Chris. Thank you for sharing that. But let me answer your question. The qualifications will be both or either. So let's break that down. So when we're talking about interest only, and remember, you guys, this is under normal market circumstances. Interest only and ARMs right now are not really going to be to our advantage. More often than not, the straight 30-year fixed principal and interest is going to offer the best path forward. Okay, I hope that changes real soon. But under normal circumstances, whether it's going to be debt service coverage ratio, where all we care about is the property's income divided by the payment, or debt to income ratio, your income divided by your monthly liabilities on your credit report, it's going to be a factor of either. You can choose from either of those things, and depending on what your qualifications are, the interest rate's going to vary a little bit, right? A debt service interest only versus a full income DTI loan interest only. This guy over here, the full DTI, debt to income, is going to have a lower interest rate than a debt service interest only will. So it'll be subjective, Chris, to which classification you fit in at that point in time. Thank you
Okay,
for the
great.
question. Yeah.
Thanks.
All right, we've got another one here from James. He asked if you can compare the interest only loan versus a 10-year fixed ARM loan.
Yes. Oh, sorry. I was doing months. Forgive me. Okay, let's check it out. So what James is asking is, and it's been a while since I've done this math. So let's compare. Well, let me go back. So let's start over again. Okay, so here's our 30-year fix. No. He wants interest only. I'm sorry. Sorry, guys. So a 10-year loan, let's say that the interest rate on a 10-year fixed, this is amortized over 120 months. Okay, look at that sucker. $4,000 at 7. Let's say that 6.25. In fairness, I should know the spread here. I don't, so I'm guessing. I use 6.5 as a lower rate from a 30 to a 15, and I'm using 6.25 from a 15 to a 10. I'd probably need to go and double check all of this, but let's just take it for what we've got here. So hold on, let me get our interest only payment times 6.25. I'm assuming, by the way, that the interest only rate is the same as the fixed rate. That's another variable that I did not quantify. So the interest only, let me make sure I did that right, James. Hold on, 350 times 6.25% divided by 12. And then just because I'm going to say it, I know that I hope it doesn't sound stupid to anybody, because you probably, right, this is the math to figure interest only is ridiculously easy. Just for those that may not know, take the loan amount times the interest rate percent sign, divide by 12. Okay, you're going to be within a few bucks. It's as easy as that. Okay, just in case. Interest only at 350, 6.25 is going to be $1,822 versus this guy. And then we're going to come down here and look at that math again. So minus, so 1822.92. I'm just going to call it 1823 minus 3930. Okay. So 2107 is the difference between an interest only and a 10-year. Everybody following me? If you're not, somebody raise your hand and I'll slow down. Okay, 2107 times 60 months is 126,425. So that's the cash flow. That's what you're keeping if you were to take the interest only in your kitty, 126,425. Let's see how this math plays out at the 60 months. So we started at 350, and at halfway through 87, this is how much interest you've paid, and this is what your ending balance, 102. So let's do the math. Hold on, guys, I can't do mental math. So 60 months is 202. We'll just call it 202 even. $148. And what did I say that difference was? I'm sorry, gang. Give me a minute. 350. 2107. So 126. So it's a little bit better on the 10-year, James. I would grant you, of course. I mean, that was what I expected. So what you're leaving in 126 is what you're keeping in cash flow, okay? Versus 148 is what you've paid down on the 350 starting balance minus. So it's a $21,000 difference there between the two, but do the same calculation. And the other thing too, because these are much bigger numbers that we need to account for, let me take this sequentially. So the cash flow, immediate cash flow, okay, versus what you're tying up, it's $21,000 and a little bit of change difference. To get out that $21,000, that difference between what you've paid down on the mortgage and the interest only that you've been able to hold on to over that 5-year period of time, what is the refinance going to cost you? Okay, 10 grand. So you're still 10,000 ahead on the 10-year option, on the amortized 10-year fixed. The interest, you got to, and that's a variable we can't really solve for mathematically right here, but you also have that incentive that, let's say that it gives you half that back, maybe more, depending on what your brackets are, et cetera. So now we've got 5,000 left. Then the final piece here, I would say, is that 126,000 over that period of time, let's just take it in 2.5 years. I would have taken that cash and redeployed it for another investment and whatever return that I'd be getting on that. And I think probably far exceeds the value of that 10-year against the interest only. So let me say that another way. So if in 5 years' time, the interest only is going to keep 126,000 in my pocket, let's take it at 2.5 years, half the time. So I've got $63,000 that I have that I would have then deployed. I would have stockpiled and deployed for a down payment on another investment, perhaps, and the return of that, and the interest credit for that, and the appreciation for that, and the rent increase appreciation for that, right? I think you guys see where I'm going with that. James, how did I do? Did I answer your question? Is that what you wanted to see? They can unmute themselves, right, Carly?
Yes, they can.
Feel free, James. If not, you can put it in the chat if that's easier, sir. I still like the interest only for those reasons. Now that might not fit into your scenario. Your circumstances might have more hair on it. There might be more details that you know make the amortized mortgage more to your advantage, and that's fine. What else, gang?
Hey, Caeli, I'm going to pop in again with another question.
Yeah.
What's the term typically on interest only? Is it typically over 30 years, or because I know I'm familiar with bridge loans, obviously, that are interest only, that are like a year term.
Mm-hmm.
But on a, kind of on this type of loan product, I think you're talking more about it being spread across a 30-year term. Is that fair?
Yeah, it'll be, yeah. So usually you're going to be able to choose like a 5-year interest only with a 25-year repayment, or becomes principal and interest, and it can adjust after that. I think the one that I like the best is a 30-year, 10-year interest only, 30-year term with a 10-year interest only. After that 10-year interest only period of time, if you just kept the mortgage, it's going to take that interest rate and it's going to calculate a payment, an amortized payment over the remaining 240 months or 20 years.
Okay.
Yeah, I think that's the one that if I got to choose, that's the one I would choose.
That's really interesting. I didn't even know that was a thing. So
yeah, yeah. Well, it's been a while, right? They haven't really been a prolific part of mortgage related finance, especially for residential real estate investors. Soon, let's hope it's back soon. What else? Anybody else? Carly, anybody got anything?
No questions in the chat, but pop those in there if you have them, or you can unmute yourselves if you want to say it out loud and ask Caeli.
Anybody? Okay, well, if I'll give you a couple more seconds to think of it if you want to throw something at me. Just to recap, Friday you guys will see our newsletter come through. Property management. I'm going to be sharing sometime in September my own personal experiences with property management and some of the do's and don'ts that have befallen me, some wins and losses. And property management. There was another thing I was just going to tell you. And that's it. That's gone. I don't remember. That's okay.
Really, this is Jason.
Hi, Jason.
Just real quick, I ran the numbers on 10% return on that 2107.
On the what? On the what?
2107.
Yeah. Okay.
That comes up to 161,000. Exceeds your 148.
Thank you,
tax
brother.
Benefits, you got your rent increases, depreciation of the property, so on and so forth. So yeah, I'm like everybody else. This is pretty cool stuff. So thank you.
Double J, thank you. Did everybody get what he just said? Does that make sense? Does that resonate with everybody? What he did the math and gave us what the return on that would be, and it more than exceeded the benefit of the locked in equity that you would be building on a 10-year amortized mortgage. So for my money, I'm always going to go interest only when it makes sense. Now, let me take this. So I didn't talk about this yet. And there was something else I was just going to tell you guys, and I just forgot it again. And if I remember it, I'm going to write it down so I don't forget. Let's talk about so if we have this interest only, actually, do I want to do it that way? Well, I'll even come back to that. I know what I was going to say before. This is going to be made available. If you guys want this amortization table, it's the one that I like. Feel free to take it down. Just as a reminder, this will be on the community if you need it or want it. My recall, I think it's early onset menopause, TMI, but I don't know. This is for the ladies. Anybody else that has any tricks about it, I am all for sharing. My recall the last couple of months has been horrific, and it's making me crazy. Sorry, dudes. I had to share because you're probably noticing that I will have something and I'll be talking about it and then it's just gone again. I'm not completely incapacitated, just only partially. I'm told that it will run its course and I'll be back to new soon. What was it?
Well, if you do want to join the community and you're not a part of it already, you can always check it out on our website, just so you guys know. So if you want to see that there, the loan amortization schedule, or it's available on the reminder emails that we send out up at the top left-hand corner. There's a hyperlink that you can join the community. So whatever's easiest for you, but yes, please join us there. And that way you can play around with this. And then we do have a couple more questions.
Okay.
Let's see. We have one here from Tanya. She asked if you could explain ARM adjustment caps. 215, I'm guessing, is that in different years, Tanya? 2 years, 1 year, 5 year?
No, I'll tell you. I know exactly what she's talking about.
Great
question. So this is the mechanics of an adjustable rate mortgage. Every adjustable rate mortgage will have certain rate caps associated, and they change depending on the product. But a rate cap is the maximum that the interest rate can adjust to in any period of time. And the numbers that Tanya gave us were, what I wrote it down, 215. Okay, there's 3 numbers, a 2, a 1, and a 5. The first number means that at the anniversary of the locked in rate period, let's use a 5-year, okay, a 5-year ARM. That means that the interest rate that you secured on day 1 will be the same for 60 months or 5 years. The 2 and the 215 that Tanya gave us is the first rate adjustment. So in month 61, potentially the rate can adjust up to a maximum of 2% from where you started. Let's say that you started at 5%. Okay, so the very first rate adjustment cannot exceed 2% over 5. So 7% would be the maximum that the interest rate could just adjust in that first adjustment. Now, the piece that you would need to understand too is that how often after the fixed rate portion can the rate adjust? Generally, it's going to be once a year. Sometimes it can be twice a year, every 6 months. Okay, we're going to say for our example that the rate can only adjust once a year. So the first rate adjustment in that one time per year, the rate will not be able to exceed 7%, which is 2% over our starting at 5, if that's where we started. Okay, that's the first number, 215. The second 1 means that each subsequent rate adjustment, the rate cannot exceed 1% in that 1 year period of time. So in the next month, month 73, right? So 60 months, full year later. Sorry, did I do that? Yeah, month 73, we're going to be in the 6th year. That means that the interest rate, let's say that we jumped all the way to 7. So the next rate adjustment in each subsequent one after that, the rate cannot increase more than 1%. So let's say it goes the full in year 6, or actually it's going to be year 7. Sorry, guys. It will be up to a maximum of 8. Okay, if it adjusted the full, these are the caps. It's the maximum it can adjust in each subsequent adjustment. And then the last number 5, 215, is the life cap. So that means that if we started at 5 plus 5, 10% is the maximum that interest rate could ever adjust. So depending on how it goes after that first 5 years, let me see if I can do the math really quick. The first year it adjusted the full 2 cap, so we're at 7. The second year is it adjusted the full 1%, we're at 8. the next one, 9, and then the next one, it did it again, 10, you're at your cap there. It would never, and I think that's year, if I counted it right, that's going to be year 8 or 9. You could never exceed that amount for 30 years. Because any adjustable, at least in the terms that we're talking about, let's keep using my 5-year example. This is a 30-year mortgage, okay, with a 5-year rate cap. And in our example, we're talking about principal and interest right now, not interest only. Don't confuse those. So what that means is that if you wanted to keep that 5-year arm for 30 years, which I think we've already identified that it's highly unlikely, but if you wanted to, you could just continue to let the rate adjust. If you know what your life cap is, it's never going to be over 10%. And sometimes if you kind of are, if you're cognizant or you're paying attention to where the market is, where it was, where we think it's going to go, there may be some incentive just to let the thing adjust versus going out and getting a different interest rate or refinancing into a different interest rate just because you think that the adjustable is going to start changing. It may be to your advantage. In fact, after 0809, people that had adjustable rate mortgages at that point, a lot of them started, let's say they had a 6% interest rate. And for years after that, they were paying interest at like 4% because those indexes, the part of an adjustable rate mortgage, which I don't think I mentioned. So real quickly, you've got a margin and an index. The margin in an adjustable rate mortgage is fixed. For 30 years, if you keep this loan, it will never, ever change. It's fixed. The index, whichever, there's lots of indices, whichever index you're using is the one that can move up and down, depending on the caps and the term of the loan, et cetera. So both of those two things added together is your fully indexed rate, and that's what the payment is going to be based off of. Okay, so if you know that your index was X when you started this loan, okay, and you know what your rate caps are, once the, let's 5-year, right? You've got your 5-year arm. Once that period of time has elapsed, and you check and the index is lower now than it was when you got it before, why would you refinance? Let it adjust. It can adjust down. So we just talked about the rate caps and the maximums. There's also going to be a floor, which is often, well, that's the reverse to this, the lowest amount of interest that you'll ever pay. And it's often, not always, but often the same as at least the margin. So if your margin was 5%, your floor rate is probably 5% too, because what happened at the 0809 crash is we saw negative interest rates. I don't know if any of you remember that. So negative interest rates reducing from the initial margin that they had, the banks were losing money hand over fist, and that actually added to some of the collapse. So as a result of it, we have floor rates so that that can't happen anymore during repayment. Excellent question. I hope that made sense. I know that was kind of a lot, kind of technical stuff, but good question. What else, Carly?
We have 2 more here. One from James. When would it make sense to use an interest-only loan?
I like to see an interest-only loan saving at least $100 a month. You got to do the math, and it's largely going to be dependent on the loan size. And you got to figure out, what is the plan or trajectory of the property? Do you know that you're going to keep it at least 7 years? Do you have some plans for it for trusts or legacy? There's too many variables to try and guess on that, but I would like to see the interest only be at least saving $100 a month. But you still have to do that math, and this should help you just kind of do it for you. All you have to do is find that 5-year mark, or wherever you think, maybe it's a 3-year mark, right? Wherever you know that you're probably going to be looking to refinance, pull equity out. That also depends on what the appreciation play of the property you're getting into might be. But just do the math. Find the month in which you think it's realistic to sell or refinance, et cetera. Look at the ending balance, and then you know what the difference between your interest only and your principal and interest is, and then you can do that math for yourself.
Perfect. All right. So we have one more here, but just before that, just want to let you know, Caeli, you're not the only one about the recall. It looks like Chris Barrett says that his wife also says that too. And Tanya totally understands. So
thanks, guys. I appreciate the support.
But we'll go with Michael's here. So he asks, looking for some clarification, it looks like. So the 10-year interest only mortgage recasts in a 20-year amortized mortgage with an adjustable rate after the fixed rate period.
It's not adjustable. What we're talking about is a 30-year mortgage with a 10-year interest only. So the rate at the end of 10 years will be the same. You're just going to take that rate and whatever the outstanding balance was. Let's say that you just made the interest only, which you should be doing based on this conversation. So the balance that you started with is going to be the same balance at the end of the 10 years. Okay, so you take that number and the interest rate you started with and just simply amortize it over the remaining 240 months, and that'll give you what your new principal and interest payment will be. And there's variables right there. I mean, there can be differences in the loan terms. You have to know what you're looking at when you start the loan. I can certainly help with that. If and when the time comes, send it by me and we'll look at it together, and I'll help you dissect or decode, if you will.
Awesome.
What
Well,
else?
that's it for the questions in the chat.
Okay, well, you guys, thanks so much for being here. As always, really, really appreciate your participation. It makes it fun for me, and I think we covered everything else. It's going to be on the first and third Tuesday going forward, starting in September. So just be aware that that second and fourth Tuesday of the month, as it were, I'm going to be off. It's going to give me more time to make the content a little bit more fluid and useful for you, I hope. And if there's any topics that we have not covered that we want us to recover, please let us know. Oh, and the all-in-one masterclass. Carly, we'll have to figure out when we want to do that. And it might take me a couple of weeks, months to put it together, but we'll get that out for you guys ASAP. It seemed like it was a resounding yes. Yeah, we're here on standby, gang. If you have any questions, you need us for anything, you know how to reach us. Thanks for being here. Bye, people.